To understand the working capital cycle, we must first understand what working capital means. Working capital is defined as the day-to-day finance for running a business and is used to measure a firm's ability to meet current obligations such as payment of wages, electricity, or rents. The formula to calculate working capital is a firm's current assets minus its current liabilities. Current assets are assets that are intended to be turned into cash, and current liabilities are anything owned by the organization which has to be paid back. Understanding these terms is essential to understand the working capital cycle. The working capital cycle measures the amount of time that elapses between the moment when a business begins investing money in a product or service and the moment the business receives a payment for the product or service. As one can see, everything is connected to cash because in the working capital cycle, the goal of the firm is to turn the net current assets and current liabilities into cash. The longer the cycle is, the longer a business is tying up capital in its working capital without earning a return on it. For this reason, companies aim to reduce its working capital cycle, and they try to find the correct balance of incoming and outgoing payments to maximize their working capital. At the top of the working cycle are the injections and drains. This is the cash that is lost to the government in the form of tax, to shareholders in the payment of dividends, or the cash that is lost because of the purchase of major assets. This section is shown at the top of the cycle because it is independent of the process of production and sale. The production process starts with the purchase of raw materials. This means that cash is lost to suppliers. Additionally, cash is also lost to pay for workers, production costs, and the dispatch of the goods to wholesalers or retailers. After the cost of production are lost and goods and services are finished, the output is dispatched and purchased. This is when the firm starts recovering the cash that was used on the production stage. Continuing on the cycle, we locate the cash that can be collected from debtors and sales. When a good or service is sold, cash doesn't come back immediately. Debtors don't always pay a firm right in the moment, so when they finally pay the business back, the cash returns to the firm. The money that is received from debtors becomes the firm's profit and the whole cycle starts again.